Okay, let's unpack this. Think about the biggest financial decisions you might make in your life.
A car, maybe a business.
Right, or the big one, a house. And for any of those, there's always that first hurdle,
Mm.
that initial upfront cost that feels like the ultimate test of whether you're really ready.
It's that chunk of cash.
That initial chunk of cash required upfront.
It really is the gatekeeper payment, isn't it? It's often the single largest sum of money that someone has to pull together in a liquid form.
And it's the piece of the puzzle that causes, I think, the most stress and the most delay for a lot of people.
No question. We are talking, of course, about the down payment.
Absolutely. And today's deep dive is going to be laser focused on this seemingly simple but profoundly important financial tool.
Right.
We've been synthesizing a whole stack of sources, articles, banking white papers, some historical analyses, all aimed at, defining what a down payment actually is.
And not just what it is, but what it does. We want to understand its core purpose in finance, in banking, and then explore how the amounts can, well, fluctuate wildly.
Especially in the U.S. real estate ecosystem.
Right.
Not always the same number.
Not at all. So the mission here is to move beyond just that simple definition you might find in a dictionary.
Yeah.
We want to get into its dual nature, what it does for the lender, acting as this vital financial shield for them.
And then the other side of the coin, what it says about you, the borrower.
Exactly. It's a profound signal of your financial stability and, I think, your commitment.
So if you're, saving for your first home, or maybe you're just trying to get a better handle on the mechanics of modern lending, you really need to understand this mechanism inside and out.
It's fundamental.
We're going to find out what this initial payment is actually doing for the lending institution, and why, when this requirement has been relaxed in the past, things have often gone spectacularly wrong. So let's start at the very beginning, square one. For anyone just jumping in, let's establish the fundamental nature of the down payment.
Right. Fundamentally, it's an initial, upfront, partial payment.
Partial being the key word.
The key word. It's for the purchase of expensive goods or services. It could be for that new car or heavy equipment for a business. But for our deep dive today, we're really focusing on real estate.
And it's a physical transfer of money, right? The buyer is giving a sum of money to the seller, or maybe an escrow agent, right when the transaction is being finalized.
That's it. Now, we should probably pause on terminology for a second.
Good point. Because while we're diving deep into U.S. financial concepts today, our sources did make a note about some international variation.
They did, and it's an important distinction, especially for our global listeners. What we call a down payment in American English is almost universally called a deposit in British English.
And in a lot of Commonwealth nations, too, I believe.
That's right. But while the term changes, the mechanical function is, well, it's identical. It's that initial sum that directly reduces the principal debt.
And this payment, which is usually cash or something equivalent, is what really kicks off the whole lending process, isn't it?
Precisely. Because it is a partial payment, it immediately establishes a fact. The buyer has only covered a fraction of the total price.
And that action instantly creates the need for a loan.
It's the trigger. It dictates the principal amount of that loan, the mortgage, the auto loan, which has to cover the remainder of the total cost.
So simple math. If you're buying a $400,000 house and you put down $40,000, that's 10%.
Right. By doing that, you're immediately signaling to the world, and specifically to a lender, that you need someone to cover the other $360,000. That $40,000 is the foundation.
The foundation upon which the entire, much larger loan is built.
Which, immediately raises the big question, why?
Why is this so essential?
Yes.
Yeah.
Why is this initial payment, which on the surface seems like a simple transaction requirement, so absolutely critical to the lender? Why can't they just loan the full amount and, charge a slightly higher interest rate?
And the answer, from what I've seen, lies in two really critical drivers for banks. One is capital stability, and the other is risk mitigation.
Let's start with capital stability, because this takes us into the deeper mechanics of how banking actually works.
Specifically, the system most of the world operates under, which is fractional reserve banking.
Right. And what's fascinating here is that the down payment does more than just reduce the lender's eventual exposure to loss.
It does more.
It actively helps create the loan capacity in the first place. So in a fractional reserve system, banks are only required to hold a fraction of their deposits as actual cash reserves. Let's just say, for simplicity's sake, it's a 10% reserve requirement.
Okay, so if I walk into a bank and I deposit $10,000, the bank only has to keep $1,000 of that in the vault. and they can lend out the other 9,000.
Exactly. Now, just transfer that concept to the down payment. When you bring your, say, $100,000 down payment to the lending institution, that acts as a fresh capital injection
Into the whole banking system.
into the whole system. The bank uses a fraction of that down payment, the reserve part, as an anchor. The rest is freed up, and it can be leveraged through what's called the money multiplier effect.
So without that initial cash, the bank would struggle to generate the massive amount of credit needed for the mortgage you want.
They'd have a much harder time. The down payment provides the stable, liquid capital base that supports the highly leveraged lending that follows. It's the fuel for the engine.
That really puts it in a new light for me. It's not just about reducing my debt. It's an enabling mechanism for creating credit itself.
It's the bedrock. But the second, and I think far more visible purpose from the lender's point of view, is purely protective.
Their safety net.
It's their safety net. It's about recovering the balance if the borrower defaults. It's a shield against the inevitable ups and downs of life and the market.
And in these high-value, really long-term loans like mortgages, that protection hinges completely on the idea of collateral.
The house itself.
The house is the collateral,
Right.
and it legally secures that loan.
This is the critical legal mechanism. When you sign a mortgage agreement, you are granting the lender a lien on your property. So if you fail to repay the loan, if you default, the lender is legally entitled to take possession of the asset.
And sell it.
And sell it. That process, of course, is called foreclosure. The bank's goal in that sale is to get enough money back to cover the entire outstanding balance of the loan.
Okay, but here's a common thought. If the house is worth, say, $500,000, and I only owe $400,000, why would the bank need any extra cash protection from me up front? Can't they just sell the house and walk away clean?
And this is where the risk mitigation analysis really gets deep, and it's why that down payment becomes absolutely indispensable. The traditional 20% down standard exists because selling a house in a distress scenario,
A foreclosure.
a foreclosure, yeah. It is rarely a clean, quick, or profitable process. The down payment reduces the lender's exposure to a number that's less than the value of the collateral itself.
To create a buffer.
It creates a buffer for all the chaos that follows a default.
Okay, so let's detail that chaos. What are the specific threats that the down payment is designed to absorb for the bank?
Okay, we can break it down into a few critical areas. The first and the most obvious one is market volatility.
Home prices don't always go up.
They absolutely do not. They rise, but they also fall. So if the market declines by, say, 10% between when you get the loan and when the bank has to sell the foreclosed property, that 10% loss is absorbed by your equity.
And my equity is primarily what I put down at the start.
Exactly. If you put 20% down, a 10% market dip still leaves you with 10% equity, and the lender's principal is untouched. But if you put 0% down,
A 10% dip means I'm immediately underwater. I owe more than the house is worth.
and the lender is facing a guaranteed loss, which they then have to try and recover from you personally. So yeah, the down payment is the primary guard against the loan going underwater.
Okay, so that's threat number one. What's next?
The second threat is the accumulation of fees and interest. When a borrower defaults, the debt doesn't just stop growing.
Oh, right.
Interest keeps accruing on that unpaid principal. Late fees start piling up. The lender is basically hemorrhaging money every single month that asset sits unsold. The down payment acts as a buffer to cover that growing gap.
And then there's the third threat, the one I think people really forget about, which is the true cost of foreclosure and disposition.
This is where it gets really expensive for the bank.
Oh, so?
Well, the foreclosure process itself is long. It requires extensive legal help. We're talking about attorney fees, court costs, title searches, property management fees.
And then during the months or even years it can take to legally seize and sell a property, the bank often has to start paying for things the former owner stopped paying for.
Yes. Like what, specifically?
Property taxes, homeowners insurance, which is crucial because the bank has to protect its asset.
And maintenance, right. Necessary repairs, especially if the home was abandoned or damaged. The costs of just getting the property up to a marketable standard.
All of that can easily eat up 5 to 10% of the home's value before the bank even puts a for sale sign in the yard.
So that standard 20% down payment,
Yeah.
it's not just some arbitrary round number.
No, it's an empirically determined amount. It's designed to absorb market dips, the legal costs of seizure, the carrying costs of taxes and insurance, and all that lost interest and fees.
It is the lender's all-weather survival kit.
And there's a fourth factor, right? You mentioned opportunity cost.
Yes, the opportunity cost of capital.
Mm.
While that property is tied up in a long, drawn-out foreclosure, the bank's capital is stuck. It's a non-performing asset.
They can't lend that money to someone else.
They can't. So the down payment helps ensure that even when they finally get their principal back, they have a much higher chance of also covering the profit they could have earned if that money had been circulating productively.
Okay, here's where it gets really interesting, I think. We firmly established the down payment as the lender's shield, their armor.
Mm-hmm.
But it's just as important, maybe even more so, for what it reveals about the borrower.
It's a signal.
A powerful nonverbal signal of financial health and commitment.
It's more than just a transfer of cash. It's a behavioral prospectus on you. Making a substantial down payment is demonstrable evidence that you possess the ability, and crucially, the sustained financial discipline, to raise a certain amount of capital over time for a long-term investment.
It's like proof of concept. If you need a $50,000 down payment, you didn't just get that in one paycheck. You had to execute a savings plan, probably for years, resisting the temptation to spend that money on other things. That proves a stability that, a simple employment history might not capture.
Exactly. And this is the evidence the lender really desires. It's proof that your finances are sound and that you aren't borrowing beyond your established means. The size of the down payment is an instant risk profile modifier.
So a borrower who can manage their liquid assets that well is statistically less likely to over-leverage themselves on the mortgage.
And therefore, less likely to default. It's a strong correlation.
Our sources often link this idea to having financial breathing room.
Yes, that's a great way to put it. The larger the down payment, the less leveraged the individual is. So if a temporary economic setback happens, a short layoff, an unexpected medical bill, a borrower with 20% equity has so much more financial cushioning than someone who has zero equity from day one.
And that breathing room can act as a safety valve. It can prevent a temporary problem from cascading into a full-blown default.
Which ties directly back into this profound psychological factor, the forfeiture mechanism.
Let's really reinforce how serious that is. If you, the borrower, default, that hard-earned down payment amount is, from the lender's perspective, forfeited, gone.
This is the behavioral economics of it all. That down payment is often the single largest pool of cash a person owns. It can represent years of sacrifice.
So the risk of losing that, of forfeiting that sunk cost, creates a massive psychological deterrent against defaulting.
Absolutely. If you only put $5,000 down, walking away when things get tough might be painful, but it's manageable. If you put $100,000 down,
You are highly incentivized to exhaust every other possible financial avenue to avoid losing that money.
you'll sell other assets, you'll work extra jobs, you'll do whatever it takes to ensure those savings are not lost.
So it's the lender using the borrower's own savings as leverage for the borrower's own success.
That's a great way to think about it. The bigger the down payment, the higher the psychological cost of failure, and therefore the stronger the commitment to succeed. It's a key indicator of long-term stability that goes way beyond just income verification.
It also, I would imagine, provides a degree of self-selection.
It really does. Individuals who know they lack the financial discipline or stability to reliably repay a massive long-term loan are often filtered out by the sheer difficulty of saving up that initial substantial down payment.
The process of saving itself acts as a necessary proving ground.
A proving ground before the debt is ever extended. It's a test. And if we connect this concept of required commitment to the bigger picture, and we look specifically at the U.S. residential real estate landscape, we see that the variance in expected down payments is just enormous.
It's not one size fits all.
Not even close. And this variability is heavily influenced by government policy and, historical market trends.
We hear 20%. So often it feels like a law. But our deep dive shows that the typical conventional range for U.S. home purchases is actually quite wide. It often sits somewhere between, 3.5% and 20% of the price?
And that depends entirely on the loan product you choose. That difference is often defined by who is assuming the risk, especially when that down payment buffer is small.
And this is where the Federal Housing Administration, the FHA, becomes this major historical and modern influence.
Huge influence. The FHA was established way back in 1934, right in the middle of the Great Depression.
This wasn't just about offering loans, was it? It was about stabilizing a completely devastated market.
That was the goal. Back then, massive down payments were often required, which excluded huge parts of the population from home ownership. The FHA came in and advocated for and, crucially, backed loans with much lower down payment requirements.
And that injected liquidity and stability back into the housing ecosystem.
It did, and that influence is still incredibly powerful today. Currently, a qualifying FHA borrower is often required to pay only 3.5% down.
That dramatically lowers the barrier to entry.
It does, but this isn't risk-free lending. This lower threshold requires the borrower to pay for mortgage insurance, typically called mutual mortgage insurance, or MMI.
So instead of the borrower providing the safety buffer with their own cash equity,
Right.
the borrower is paying a premium to an insurance fund, the MMI fund, which then covers the lender if they default.
Exactly. The risk hasn't disappeared. It's simply been shifted and insured, and that's thanks to government backing.
So that structured risk transfer is the key to accessibility for people who have the income to manage the debt, but just lack that huge lump sum of cash.
It allows the financial system to function at lower equity levels, but only with an enforced safety mechanism in place.
Okay, now we really need to contrast that structured government-backed accessibility with the high-risk speculative accessibility that emerged in the years leading up to the 2008 financial crisis.
The period from roughly 2000 to 2007.
What was happening then?
It was a period characterized by a rapidly, almost unbelievably rising housing market. And lenders, who were driven by intense competition and pretty lax regulatory oversight, decided they didn't need that 20% or even 3.5% buffer because they believed the housing market would just keep rising indefinitely. So they were willing to accept smaller or even zero down payments just to capture more market share.
And the sources we looked at detail some fascinating, if ultimately dangerous, methods they used to mask the lack of borrower equity. How did they actually achieve 100% financing?
Well, they employed several tactics. Simple 100% financing was one, where the lender just covered the entire purchase price.
That seems straightforwardly risky.
It was. We also saw seller-assisted down payment assistance, where the seller would effectively give a rebate or a credit to the buyer at closing, which was then immediately used as the down payment.
So the buyer brought $0 to the table, but the transaction looked compliant on paper.
Exactly. But the truly novel and ultimately catastrophic creation was the combination of an 80% first mortgage and a 20% second mortgage.
The infamous 80/20s.
That's the one. This was the peak of really structured financial trickery. The primary goal of an 80/20 loan was to allow the borrower to avoid both the down payment and the requirement for costly private mortgage insurance, or PMI.
Which is usually required when your loan is more than 80% of the home's value.
Right. So by keeping the first mortgage at exactly 80%, they sidestepped that PMI rule.
But the borrower still needed that final 20%.
Correct. So the lender simultaneously issued a high-interest second mortgage for the remaining 20%. And the second loan was the ticking time bomb.
It had much worse terms, I take it.
Oh, significantly worse. A much higher interest rate, a shorter repayment schedule, and critically, it was frequently structured as an adjustable rate mortgage, an ARM.
With a low introductory teaser rate.
A teaser rate that would quickly reset to a much, much higher interest rate after just 2 or 3 years.
So not only did the borrower have zero equity, meaning they had zero incentive to stay if the value dropped, but their loan payments were literally engineered to balloon.
Often at the exact same time the market was starting to correct. That combination was lethal. When housing prices finally stabilized or dropped, borrowers found themselves not only underwater,
Owning more than the home was worth.
but also facing dramatically increased monthly payments because of that ARM resetting on the second mortgage. They had no equity, so they couldn't sell without bringing cash to closing, and they couldn't afford the new payments.
Default became the only viable option for millions.
And it demonstrated exactly why that initial down payment commitment is so essential for systemic stability.
That's a powerful illustration of the danger when that commitment is removed entirely. But not all zero down options are speculative.
That's a very important point. The sources highlight essential government programs that offer complete financing, but responsibly.
The primary example being the VA loan program.
The Department of Veterans Affairs, yes. This is a massive benefit for qualifying active duty service members, veterans, and surviving spouses. It offers complete financing with no down payment requirement, and it removes the need for private mortgage insurance.
So how is the risk handled there?
It's guaranteed by the VA, meaning the U.S. government agrees to pay the lender a certain percentage of the loan balance if the borrower defaults. It's an earned benefit, not a speculative market product.
And there's another one, right? The USDA program.
The USDA Home Loan Program, managed by the U.S. Department of Agriculture. This also offers complete mortgage loans with no down payment, either as direct loans from the government or guaranteed loans through private lenders.
And who is the target demographic for that program?
This is all about regional development. It's specifically for qualifying low to moderate income borrowers who are purchasing a home in a location defined as a more rural area.
So the goal is to stimulate community stability and housing access in places that might otherwise be overlooked by conventional lending.
Exactly. It's a targeted federal tool used to address geographical economic inequality, and it relies on that same risk transfer mechanism as the VA loan.
Okay, moving on to accessibility in the current environment. We need to talk about the crucial support structures that are designed to bridge that gap. The gap between the, say, 3.5% FHA minimum and that aspirational 20% gold standard.
When we're talking about down payment assistance or DPA programs, these are now incredibly widespread.
Our sources confirmed that pretty much every state finance housing agency, plus countless local governments and nonprofits, offers some form of DPA.
And it's a recognition that the single biggest barrier for otherwise financially stable borrowers is just accumulating that initial cash lump sum.
What stands out to you about the complexity of these programs? I mean, they aren't simply cash handouts, are they?
Oh, far from it. And that's the subtlety you really need to grasp. DPA programs vary significantly in their structure, their requirements, and their conditions.
They're highly targeted.
Very targeted. They're set by the different mandates of state or local housing authorities, nonprofits, even individual lenders.
And the requirements often include things like maximum income limits based on the specific county you're buying in and residency requirements.
Exactly. These programs are generally designed to help the middle to lower income brackets. So if you earn above a certain area median income, you're automatically out. But the biggest structural difference is in how the assistance is actually provided. You usually see two main forms.
The first being a true grant, which is essentially gifted money that you don't have to repay.
That's the ideal, of course, but it's the less common structure. More frequently, the DPA is provided as a deferred second mortgage.
A silent second.
A silent second, right. This means the borrower takes out a second, smaller loan just for the down payment amount, often at 0% interest. And crucially, payment on the second loan is often deferred until the house is sold, refinanced, or the first mortgage is fully paid off.
So if I sell the house in 5 years, I have to pay back the full principal of that second loan.
Correct. Which could reduce your equity gain from the sale. That's the clawback mechanism. The money isn't free. It's what you'd call patient capital, designed to get you over that initial hurdle.
Which is why borrowers really need to investigate the fine print. Are there penalties for selling too soon? Does that second mortgage start accruing interest after a grace period?
The complexity is immense, but the assistance is tangible, and the amount can be substantial, often up to 3% of the loan amount, which is essential for covering not just the down payment, but also closing costs.
Closing costs. The hidden surprise for so many first-time buyers.
It really is. They can range from 2 to 5% of the loan amount, so DPA funds can literally be the difference between closing on the house and walking away for buyers who have just scraped together that 3.5% FHA minimum.
And an interesting detail our sources highlighted about DPA risk mitigation was the educational component.
Yes, this is fascinating. If the financial commitment is lowered through assistance, the lender often raises the commitment to knowledge.
You mean?
Some DPA programs mandate that first-time home buyers, or sometimes even their loan officers, have to take a short course, and it's focused specifically on financial literacy and the details of that DPA structure.
That's brilliant. So if the down payment is the financial signal, the mandated course is the educational commitment signal.
It's a way of mitigating behavioral risk. By forcing the borrower to really understand their long-term debt obligation, the clawback clauses, the responsibilities of home ownership, the lender is trying to increase the likelihood of success, even with less skin in the game.
A counterbalance to the reduced financial buffer.
That's right. And we also see states using DPA as a targeted economic stimulus.
How so?
Certain states and cities offer special programs to support home purchases in very specific geographic areas like neighborhoods designated for revitalization or areas where the housing inventory needs a boost.
So it's using DPA not just for borrower accessibility, but as a deliberate tool for urban planning and community investment.
It becomes a policy lever. Now, let's pivot our focus to higher risk scenarios, where that down payment requirement snaps back up, and dramatically so.
We've been talking about primary residence as the place you live, but what happens when a buyer shifts from buying a house to live in to buying a house as an investment property?
The entire risk equation changes, fundamentally. Lenders perceive significantly higher risk when you buy a home as an investment, a rental unit, a vacation home, a speculative flip.
As opposed to your primary residence, the place you sleep every night.
And the consequence of that perceived risk is immediately evident in the down payment requirement.
Like goes way up.
Way up. While a primary home buyer might get a loan with 3.5% or 5% down, an investor is typically expected to put down 20%, 25%, sometimes even 30% cash.
And they usually get charged a higher interest rate on top of that, a risk premium.
Always. But why? Why is the investment property inherently riskier? Both properties have the same underlying collateral value, don't they?
They do, but the prioritization of debt service shifts dramatically.
Explain that.
Well, if a property owner runs into financial hardship, say they lose their main job, they will almost always prioritize making the mortgage payment on their primary residence.
To avoid being displaced, to keep the roof over their families' heads.
Exactly. The investment property, while it's a valuable asset, is secondary. If that owner faces economic strain, the investment property payment is far more likely to be the first one they miss or strategically default on.
So the commitment signal is weaker because the consequence of forfeiture is less existential for the borrower.
Precisely. The borrower is more likely to view that investment property as just a business asset, one that can be liquidated or even abandoned if the returns turn negative.
So the higher down payment is required to protect against that inherent higher default probability. And you have other factors too. Investment properties tend to have higher vacancy rates, require more maintenance, involve different insurance risks. The lender needs that extra 5% or 10% cash buffer to absorb all of that.
All because they know the borrower has a lower psychological attachment to the asset. It's a clear financial manifestation of where the lender believes your loyalties will lie.
You'll protect your home. The investment property is expendable if the numbers stop working. It's just the cold, hard logic of debt prioritization.
The deeper the financial commitment, the safer the lender feels.
And nowhere is that required depth more visible than when you separate a primary residence from a passive investment.
To bring this extensive deep dive into the down payment to a close, let's try and synthesize the key takeaways of why this seemingly simple upfront cost plays such a dynamic and crucial role in the entire financial system.
I think we firmly established its dual function. It operates on two distinct but interconnected levels. First, it protects the lender.
It's their primary financial shock absorber.
It mitigates default risk, market fluctuations, and the high transaction costs associated with that long, complicated process of foreclosure. And, as we discussed at the start, it's essential for capital stability within the fractional reserve banking system.
And then second, it's a crucial signifier for the borrower. It acts as a powerful self-selecting mechanism.
It proves you have the financial capacity and the sustained discipline necessary to save a substantial sum of money.
Which increases both your psychological and your economic commitment to see that long-term debt through to completion.
And this discussion inevitably connects to two other huge financial concepts. We touched on foreclosure, which is the legal mechanism that gets invoked when that down payment buffer is breached and the debt goes irrecoverably sour.
And, critically, mortgage insurance.
Right. Mortgage insurance, whether it's the government-backed MMI for FHA loans or private mortgage insurance, PMI, for conventional loans, is the financial instrument created to formalize and cover the very risk the down payment is supposed to eliminate.
So when a borrower puts down less than 20%, they're basically paying a fee to shift that unmitigated risk to an insurance provider.
Which just goes to show how non-negotiable that risk mitigation function truly is in modern lending.
We also observed the profound historical lesson learned during that period from 2000 to 2007.
Yeah.
That aggressive trend towards zero down payment options, often structured through those toxic 80-20 mortgages, proved that removing that initial financial commitment can destabilize the entire market.
Even if the original intention was just to increase access, that whole experience reaffirmed the necessity of the down payment buffer.
And this leaves us with a final provocative thought for you, the listener, to carry forward. We know that the FHA has shown since 1934 that 3.5% down can be viable, provided that risk is properly insured.
And we know that 20% is not a legal rule, but a standard expectation in conventional lending. The data suggests that lenders can operate safely with lower equity.
So we have to ask, is the overwhelming cultural and financial expectation of 20% purely about cold, hard risk mitigation? Is it just the safest number for the bank?
Or has it evolved into something more profound? A deep cultural marker of financial discipline, a signifier that a borrower is truly ready to take on the massive responsibility of long-term debt, regardless of whether insurance is available.
Is 20% the measure of capital, or is it the measure of character?
A truly challenging question, especially as housing costs continue to outpace wage growth.
It is. Thank you for joining us for this deep dive into the down payment.
We hope this provided you with the necessary context and detailed mechanics to approach your next financial negotiation with informed confidence. Until next time.